It's a lot of work to manage a rental property. Investing in rental property is just one of many ways to set yourself up for a steady stream of passive income. But unlike most passive income investments, real estate investments usually require you to be involved in the business to make money. Unless you hire a property manager, you will be responsible for finding and managing tenants, handling any necessary maintenance, and paying all the bills. You can invest in real estate without buying a rental property in a lot of other ways. Participating in real estate syndications is one that simulates direct ownership without any management duties. You can become a limited partner in a single real estate asset without exerting any effort to collect passive income. A real estate syndication is when a group of investors pool their money to buy a property that would be too large for a single investor to buy on their own. Examples of these types of properties include apartment complexes, office buildings, and warehouses. A desirable property will be chosen by the deal's sponsor, known as the general partner, who will then invite additional investors, known as limited partners, to join in the purchase. The sponsor, who is usually an established real estate company, will manage the property or hire a property manager on behalf of the limited partners. Many sponsors will provide the option to invest in a real estate syndication deal either directly through their website or through an online marketplace. Real estate syndication deals have several benefits. Gain passive income. The general partner will begin paying cash distributions to the limited partners once an acquired property has stabilized. It's real passive income because you're not the landlord but an investor in the property. Participate in the property's long-term upside potential. Limited partners hold an ownership interest in the underlying property. As a result of this, they stand to gain as the property increases in value, which can be cashed in either through a refinance or the ultimate sale of the property. Invest alongside experienced real estate professionals. General partners typically have extensive experience owning and managing real estate across the market cycle. This allows limited partners to invest alongside proven real estate professionals. Diversify your portfolio. Investments in private real estate tend to be less volatile than the stock market as a whole. Because of this, they protect an investor's portfolio from the volatility of the stock and bond markets better than publicly traded real estate investment trusts. Access to properties you can never afford to buy. Investors in the real estate market may be able to afford a duplex or a few single-family homes, but they probably won't have enough money to buy an apartment building or a commercial complex. You may be able to own a portion of a property that you otherwise would not be able to buy if you participate in a real estate syndication. The majority of real estate syndications are restricted to accredited investors only. An investor must have a net worth of at least $1 million to be eligible. Even though many investors probably don't meet those requirements right now, they could if their net worth grows to more than $1 million. Another disadvantage is that most real estate syndications require a large minimum investment, typically between $25,000 and $50,000. Compared to other types of real estate investments, like in real estate investment trust, that's a hefty minimum to meet, but it's less than what you usually have to put down when you buy a rental property. These investments are also hard to sell quickly. You cannot sell your limited partner investment until the general partner decides to sell the property, as many syndication deals have 3 to 10-year holding periods. The majority of general partners make their money through a promotion, which is a percentage of returns that are greater than a predetermined minimum. Profits can be substantial, with the general partner and limited partners typically sharing 20% to 70% upon refinancing or selling the property. Because of the frequent need for active management, rental properties are not a passive investment. On the other hand, real estate syndications are passive investments that are run by real estate professionals with a lot of experience. In addition, they provide investors with access to property types they could not otherwise afford, allowing them to diversify their real estate portfolio. Because of this, they are worth a closer look for those people who meet the requirements to be accredited investors and have the capital that they want to invest in real estate in order to generate passive income. Thank you for watching. Support the channel, subscribe, and don't forget to press like button. Feel free to write in the comments below on what topic you would like to see in new video.